Hi everyone. So we are going to formally start with the chapter 1, C as it is written as C1, which is scope. Uh, in the consolidated commentary, the paragraph 1 uh, addresses the scope of application of BEPS Pillar 2 framework. It applies to constituent entities of multinational enterprise groups, M&E groups, which meet the following criteria, which meeting consolidated revenues of equal to or greater than 750 million euros. And that should have happened in at least 2 of the 4 prior or preceding fiscal years. So in 2 of the previous 4 fiscal years, if the revenue has been more than 750 million euros consolidated revenue, then the uh, uh, BEPS Pillar 2 framework applies. Of course, this condition is modified by Article 6.1, which we are going to study later. It's going to come ahead. And that article addresses mergers and demergers. And there are special rules for revenue threshold application that we will study when we go through Article 6.1. Second paragraph talks about uh, definition of entity, which has been addressed in chapter 10. Now, please understand that chapter 10 is purely for definitions. The BEPS Pillar 2 framework is a quite a complicated, quite vast framework, and it has used a number of definitions and expressions. All of them have been converged and collated in chapter 10. So we are going to go through that chapter 10 as well, and we can always refer to chapter 10 for specific definitions, expressions that have been defined there. So entity has been, designed, the expression entity has been designed to include legal persons, partnerships, trusts, and similar arrangements as well. Group formation, entities under common control are usually ordinarily referred to as groups, where income would be included in the same consolidated financial statement. So that's the concept of group. Consolidation always applies to groups. One more expression that is very relevant here is constituent entities. The constituent entities are basically group entities subject to GloBE rules. These are those entities to which the BEPS Pillar 2 framework applies. And these include separate treatment for entities with permanent establishments. Although you might understand, you must have gone through the discussion on the permanent establishment. Different types of permanent establishments are there, and they might not necessarily sometimes have, most of the times actually have a separate legal identity of their own. But yet, permanent establishment are treated under the BEPS Pillar 2 framework as economic entities, separate economic persons, so fiscal entities. So they are treated as separate entities. Uh, Now, excluded entities have also been addressed in the chapter 1 itself. You will see in the later parts of the chapter, the last parts of the chapter, which addresses excluded entities. Certain entities are excluded from rules. And additional definitions of excluded entities we'll be able to find in chapter 10. Now, the very first article of this chapter 1, which is Article 1.1, is scope of GloBE rules. So we just discussed about the revenue threshold, that is, to which entities does the GloBE rules apply? So the application criteria is that they the GloBE rules apply to multinational enterprise groups which meet these conditions, meaning their annual consolidated revenues should have been equal to or greater than 750 million euros in at least two of the last four preceding fiscal years of the last four fiscal years. Now, purpose of the threshold excluded from GloBE rules is smaller groups. So when you put 750 million euro condition, automatically smaller groups would uh, go out of the scope of or the ambit of the GloBE rules. Similarly, those that are purely domestic groups within one country only, they will also go, right? So what we are talking about is those groups, those multinational enterprise groups that are in more than one countries, more than one jurisdictions. You must be thinking probably we need to define many groups. So we are going to reach there soon. Very next article probably you'll see we'll be addressing M&E groups. Excluded entities have been detailed in the last part of this chapter. We're going to reach there. Now, the subsidiary article of this 1.1, article 1.1.1, which addresses the application. I think we've discussed about the 750 million euros revenue threshold of equal to or greater than 750 million euros in consolidated annual consolidated financial statements of the ultimate parent entity. So this expression is going to be used as well. Ultimate parent entity, which is the highest level of entity in a multinational enterprise group. It applies to constituent entities of multinational enterprise group meeting the 750 million euro threshold. Um, the consolidated financial statements are usually prepared by the ultimate parent entity. Now, time frame again in the last 2 of the 4 years. So it's a kind of a repeat. Now let's look at what the commentary has been. The consolidated commentary document, which is almost 400 pages long. So in that, the paragraph 4 talks about two main elements: constituent entities of an enterprise, multinational enterprise group, M&E group. It applies only to entities within a multinational enterprise group. First thing. This whole BEPS pillar 2 discussion, the framework, the rules, they apply only to constituent entities of the M&E group. First thing we should remember. Definitions of M&E group and constituent entities we are going to see in 1.2 and 1.3. This article is 1.1, the scope only, right? So immediately after that, we're going to see M&E group and constituent entities. Revenue threshold, 750 million euros. By now, we should have remembered last 2 of the 4 preceding years. And it also aligns with the CBCR, country by country reporting rules to minimize compliance costs. So based on this, the country by country reporting framework also utilizes the same 750 million euro threshold. Paragraph 5 talks about policy rationale for revenue threshold. So why this revenue threshold? Cost benefit balance reduces administrative burdens while preserving tax policy goals. Because we're talking about essentially quite large groups, leveraging existing CBCR data for monitoring. So if it were like a much smaller, relatively smaller threshold, less than 750 million euros, probably the size of the population would have been huge, immense, and it would be very difficult to monitor. It would be very difficult to apply as well. Implementation would have been a nightmare. So that's why 750 million euros probably poses a reasonable threshold. Volatility mitigation. So a 2-year test avoids frequent entry and exits. So the 2 years test would ordinarily provide a bit consistency and stability to this model, because otherwise, a lot of groups or enterprises, they it would become very uncertain. Some would meet and immediately next year they would not meet, and it would become very confusing and it would become inconsistent as well. So that helps, giving the extending the criteria to 4 years and saying that any of the last two, any of the 2 years during the last 4 years, that would standardize the inclusion criteria for those entities to which BEPS Pillar 2 framework applies. Excludes current fiscal year from the threshold test. So certainty at year start. Yeah, that's a very good point. Meaning if you're testing a given year where you want to apply that the BEPS Pillar 2 framework, people, the entities have to do provisioning for their, tax liabilities, etc. So it is always needed. It's tax certainty is a very important aspect of taxation. So at the beginning of the year itself, you would the company would know why, because this is a kind of a look back test, looking back at the previous 4 years. We exclude the current year. We look at the previous 4 years. Any of the 2 years in which 750 million euro threshold was crossed, that would mean that if the 2 year criteria is met during the last 4 years, that would mean that this current year, there is no escaping. It would be subject to the various requirements of BEPS Pillar 2, such as the 15% minimum tax. So there will be a certain level of certainty. Now, paragraph 6 talks about application of revenue threshold, consolidated financial statements based on revenue reported in group-wide consolidated statements. Naturally, all the revenue is reported on group-wide consolidated statements, and it follows IFRS, must follow an applicable financial accounting standard. So it's an interesting expression. We should see this: acceptable financial accounting standard, financial accounting standards. So why so? Because you would find that in a number of countries, even in Europe as well, uh, IFRS might not have been 100% fully adopted. Naturally, US also uses a different framework called US GAAP, which is slightly different from IFRS. But it's not only US. If you go to Europe, number of countries, you would find that they have their slightly different versions of their financial reporting standards. So it was needed that um, there should be a harmonization of and standardization of the financial reporting under BEPS Pillar 2 framework. So that is why the concept of acceptable financial accounting standard was brought in. So we're going to look at the precise definition of that, but this has been addressed in Article 10.1 of Chapter 10. But just to let you know, it includes IFRS, it includes any authorized financial reporting standards that a jurisdiction has approved. So yeah, so that was paragraph 6. Now talking about paragraph 7, exceptions for new or restructured groups. Recently created groups, rules apply only from year 3. So 2 prior years at least needed for testing. So naturally, because if you simply comprehend and apply the rule, it says any 2 years during the previous 4 years. So if the duration of if the group is so new that if it even hasn't completed 2 years, then this whole criteria would not even be applicable, because it requires at least 2 years of existence. So recently created groups would not be applicable until they complete their first 2 years. From year 3, yes, you can test year number 3 for the first time for application of BEPS Pillar 2 framework. Previously standalone entities, sum of standalone revenues, sum of standalone revenues should be equal to or greater than 750 million euros in prior years. So it's, if you really think about it, what we are saying is it's a kind of a deemed consolidation, or you're doing consolidation post facto basis, meaning previously these entities were standalone entities. They were not part of the same M&E group, and later on it was considered, or it actually became or was deemed to be a multinational enterprise group, M&E group. Then how do we test the current year, whether the 750 million euro per annual consolidated turnover condition has been met or not? The answer is that what we will do is we will consider the standalone revenues, we will add them, and we'll see whether this 750 million euro threshold was exceeded or not. Simple. Now coming to paragraph 8, application timeline for new groups. Earliest possible application, of course, we discussed that will be year 3, requires 2 prior years. I don't think we need this example, years 1 and 2, 750 million euros, so no application in the first 2 years. Third year, yes, we can apply. Illustrative example, this again is being repeated. So I'm going to go to paragraph number 10, definition of revenue. Now that's an interesting one. What would be included in the concept or the meaning of revenue? Ordinary activities, goods, services, core operations, net gains from investments, realized as well as unrealized. That's very interesting. Huh? Unrealized gains are also considered as part of the revenue. Extraordinary, non-recurring income, so that would also be considered as revenue. Extraordinary or non-recurring, uh, income. Aggregation required if revenue split across line items. So yeah, I mean it is quite possible. Sometimes you might find revenue, in other income, you might find in extraordinary income, you might even find in other comprehensive income, something that is that will never be reclassified. So and wherever that element of revenue lies, it will need to be aggregated. So it is a requirement. Now, exclusions, intragroup transactions, obviously, it's common sense that if it is intragroup transaction, this would be eliminated on consolidation during the consolidation phase. Interest income outside ordinary activities. If that is the case, for example, ancillary manufacturing interest. So if it is outside ordinary activities, that kind of an interest income would be excluded. Financial entities use net banking product or revenue per accounting standard. So net banking product or revenue, one example would be net interest expenditure, meaning interest expense less the amount of interest income that has come. But if you look at the financial entities, that in net interest uh, you know expense, that is applicable to non-financial entities if you really think about it. Why? Because usually in 90%, 99% cases, it's the interest expense that would exceed the small amount of interest income, because they're not into financial services business usually. But this point that we just read, financial entity, this is for financial services industry. And in there, the core income comes from usually from lending operations, right? So the income element would be greater than the expense element, usually. Otherwise, the whole business model fails, right? So use net banking product uh, slash revenue per accounting standard. So we would want to look at. It's a very interesting point that we should understand that uh, the various segments, revenue segments, like for example, if it is investment, so the amount of return on investment that was reaped or earned minus the expenses that were the interest expenses, if at all, that was incurred in order to earn that revenue. So it will be seen on a net basis. So that's the concept that is being propounded here. Now, one paragraph 10.1 talks about comparison with the CBCR threshold. Based on country by country reporting revenue threshold, but not identical. GloBE uses 2 of 4 prior years versus CBCR's single year test. So CBCR, country by country reporting test, is slightly different. It probably uses only single year test, but GloBE has a broader criteria, and definitely it allows for greater stability and greater standardization. So it uses 2 out of the for prior years. Common basis, both use consolidated profit and loss revenue under financial accounting standards. So that's the common feature in both in CBCR and GloBE rules. Now, paragraph 10.2 talks about revenue presentation variability. What is the challenge? Accounting standards allow divergent revenue presentations, single line versus itemized. Uh, Now, that's a challenge. Need for uniformity, it requires clarification to ensure consistent GloBE application. It, yeah, so from industry to industry, uh, the revenue presentation can differ. The line item presentations can differ. Sometimes you might have, for example, in the insurance industry, wherever show various streams of revenue, the income minus corresponding expense is shown, deducted, and the net result is shown. So that's a situation. One could argue that we should consider revenue taken, aggregated in one place and expenses aggregated in another place, but it would not make much sense when we talk about insurance sector. So the from industry to industry, the presentation differs. So to consistently apply the GloBE rules, the need for uniform presentation has to be considered, and it would become even more complex for much larger groups that are there across the world. If you talk about UAE, for example, there are huge companies that operate here. Venture cap funds are there, sovereign wealth funds are there, ADIA or IHC or uh, Mubadala, etc., which are into diverse industries. So that's where the need for uniformity becomes even more important. Presentation and consolidation, it becomes a lot more important and challenging. Now, coming to paragraph 10.3, core revenue definition, that includes uh, inflows from ordinary activities. Now, since we are addressing the definition of core revenue, it would include inflows from ordinary activities. We call it SIGA, right? Core income generating activities, goods, services, production, etc. And they would ordinarily be gross amounts, pre-cost reductions, net of course, discounts and returns. So the revenues are usually reported net of discounts and returns, so which is fine. So that would be the overall makeup or structure of revenue. Now, aggregation, which has been discussed earlier as well, combine all revenue line items if separately presented. Why is this important? Why is this paragraph 10.3 important? Because this revenue threshold of 750 million euros, if you want to really test it, it is important for us to be able to uh, you know segregate the gross revenue in line with the definition, the gross inflows. Basically, if you look at these two bullets, these are the gross inflows. So we have to be able to not only segregate the gross inflows from ordinary activities and even from other activities, but not only segregate them, but we have to be able to aggregate them as well. Only then will we be able to ascertain whether the revenue during the last any 2 years, during the last 4 years, exceeded the 750 million euro threshold, per annum threshold. Now, paragraph 10.4, which addresses additional inclusions, mandatory additions, net investment gains, whether it is realized or unrealized, even the extraordinary and non-recurring items. So, these will also be considered as part of revenue. Netting rule: offset investment losses against gains if separately reported. So it is allowed uh, to offset investment losses against the gain if they are separately reported. Now we will talk about paragraph 10.5, which is for financial entities. There is a special treatment for financial services entities. Use activity specific metrics, net banking product. So if it is deposits, then we have to look at the revenue that was earned through deposits, placements into treasury opportunities, and the amount of profits that were actually paid to the deposit holders. So that's a net banking product performance. Net amounts permitted for financial transactions, interest rate swaps, for example. So yeah, so again, I mean, the interest rate swap is fixed versus floating. So if there was any, spread in between that, whether it was a gain or a loss, it in either case, it's the net result that is reported. That's a special treatment allowed in case of financial entities. One example has been quoted in paragraph 10.6. Ancillary interest income reported below operating expenses. So it's a very common place if you really look at so many financial statements in non-financial entities, as it is mentioned here, manufacturer. So usually if they have taken loans or debts, etc., so there's an interest expense, but they get some level of interest income as well because of their treasury placements or etc. So that ancillary income is reported as other income below the operating expense, below the operating results, operating profits. So why do we do that? Because that's not part of the ordinary activities. There is another example reported under paragraph 10.7 for an equipment seller or a lessor. Included interest or leasing income reported as core revenue. Uh, Interest or leasing income, naturally it is reported as core revenue because it is the very business of a lessor. They earn interest through lending. Uh, Key distinction: integral to ordinary business activity. That's why the interest income or leasing income is reported as the core revenue because it's integral to the ordinary business activities. Paragraph 11, a very interesting aspect or topic: minority interest treatment. So full revenue inclusion, no reduction of minority holding. So when we talk about revenue, when we ascertain 750 million euro threshold, when we test that threshold, we don't do any reductions to that revenue because of the minority holdings. No, it will be at that time minority holdings consideration will be ignored. It will be seen as the entity will be seen as a whole, as a holistic economic unit. Eliminations exclude intercompany transactions. Yes, I mean intercompany transactions only, but that has nothing to do with, if you really think about it, that has nothing to do with minority interest. So if there was a subsidiary and there was a parent or and there was intercompany transaction, then yes, the elimination is allowed. Intercompany transaction elimination will very much be done. Excluded entities in threshold. Uh, there's a principle: count if consolidated financially. There may be entities that are excluded from the consideration of pillar two pillar two tax. Uh, they'll be included or they'll be counted if they are consolidated financially, even if exempt from GloBE rules. So while calculating the threshold, revenue threshold, that will be considered. The revenue of those entities which are actually, even if they are exempt from GloBE rules, the, the revenue will be considered if they are consolidated simply. Purpose: it aligns with the CBCR and it prevents fragmentation. Now, fragmentation uh, is a different topics whereby artificially separate separation of business, that's fragmentation. So it it allows for better reporting of results for the purposes of application of tax. The whole idea is it goes to the benefit of the common people, the public, if uh, if the GloBE rules are applied properly on a just and fair basis. So so that a minimum tax of 15% may be levied. So paragraph 13 talks about currency conversion rules. So there is an annual rebasement. Use December prior year average rate. So that's a currency conversion rule. Last year's December rate, effective at fiscal year start. So, if there is a currency that needs to be converted and we are confused as to what we should consider because of the fluctuation of the rate, then what do? We use use the December prior year average rate. So in the December, what is the average rate? That rate we will consider at the year start of the current year. Example, July 2024 financial year uses December 23 rate. That's an example given under paragraph 13. Paragraph 13.1 talks about currency conversion for threshold testing. When? When are we going to consider currency conversion? At the end of the fiscal year. For example, 30th June 2025 for financial year 2024. 30th June 2025 for financial year 2024 to June 2025. So the year started in July, financial year July 2024, and it ended in June 2025. So if you really think about it, that's the last date of the year, 30th June 2025. So at the end of that's what is being said, at the end of the fiscal year. So we consider the last day of the closing day of the year. And what is the conversion rule? If financial statements use different currency than local GloBE threshold, convert using December prior year average exchange rate. So, for example, December 2023 rate we will use for July 2024 financial year, which started from July 2024. We'll use this rate which was applicable in December of the last year. So why do we do that? Because see, if we want to apply a tentative rate for transactions that are happening now, we can consider the last year rate. Although this whole discussion, like of currency conversion or actually translation, if you really think about it, this whole discussion is for threshold testing. And this happens where when the functional currency is different from reporting currency. So when in case of uncertainty, what we do is we take the December last year average rate, and we apply it to the current year in progress. And then at the end of the year, as it was already mentioned before as well, when the year completes, then we simply consider the last day, the cutoff date, rate prevailing on the year end date. Paragraph 13.2, differing subsidiary fiscal years. Now, different subsidiaries are there, and their fiscal years differ. What do we do in that situation? Common scenario: ultimate parent entity UPE uses 31st December financial year. Subsidiaries use 30th November. So there's a 1 month gap. So if I recall correctly, IFRS have addressed this, by the way. Accounting method 1 includes subsidiaries full financial year ending within ultimate parent entity's financial year. For example, November 2024 uh, financial year. In December 2024, consolidated statements. So we just ignore that 1 month difference. So it's a teaming and leading kind of an effect. So we include last year's 1 month and we let go of 1 month of the current year. So November, we consider the November year end for the subsidiary, and December as the beginning of the year. 1 December to 30th November. That's the first method. Or then there is a second method as well. Straddle adjustment. Combine 11 months of prior year plus 1 month of the current year. So that's that we act a little patiently. We take the actual results of the last 11 months, which coincide with the group or the ultimate parent entity's financial year, and then we wait for the subsequent period of the subsidiary, period subsequent to the year end date, and the very first month which coincides with the ultimate parent entity, we include that so that this harmonizes and aligns with the ultimate parent entity's fiscal year, financial year. Now, method 1 and method 2 applications have been identified in paragraph 13.3 and 13.4. Let's quickly look at it. First method 1 was we ignore the 1 month difference. Directly incorporate subsidiaries entire financial results. Same thing it is being said. May include pre-ultimate parent entities financial year transactions in GloBE computations. May include pre-ultimate parent entity financial year transaction in GloBE computation. Uh, and the second method, allocate subsidiaries income to align with UP's financial year. Same thing, like we discussed that. Take 11 months of the subsidiary and then wait for some time until the first month also completes until 31st December, and 1 month, that December 1 month additional that actually falls into the next year of the subsidiary, we add it together with the 11 months so that the year aligns with the ultimate parent entity. Paragraph 13.5, which is GloBE compliance rule. What is that rule? Golden rule: follow consolidation method used in financial statements. Use subsidiaries full financial year data or use adjusted straddle amounts. Same thing is being repeated. Uh, Let us talk about paragraph 13.6, which is for excluded constituent entities. So there is a scenario provided. Um, Subsidiary which is not consolidated. There is a subsidiary not consolidated due to materiality reasons. Okay. Rule: use subsidiaries financial year ending within ultimate parent entity's financial year, as per article 3.1.3. That this article we are going to probably read later in article 3. This is article 1.1 going on. So the rule was use subsidiaries financial year ending within UPE, ultimate parent entities financial year. Uh, that was for the excluded entities. And what about joint ventures? Same treatment if JV financial year differs from the ultimate parent entity. So basically, that amount of subsidiaries financial year that ends within ultimate parent entity's financial year. Like in the previous example, we saw that the ultimate parent entity's financial year was ending on December. Subsidiary's year was ending in November. So we consider that year that was ending in November and simply include it. So same treatment is afforded or applied to joint ventures as well. Paragraph 13.7, JV or non-consolidated entity compliance. Key requirement: align GloBE computation with ultimate parent entity's financial year. That's the key point. So we have to look at ultimate parent entity's financial year and we align the subsidiary or JV's financial results with that year. Uh, let's go to an example that has been cited, which is paragraph 13.8. Ultimate parent entity, let's say M&E Group A, their year end is 31st December. Now the subsidiary, which is constituent entity B, their financial year is 30th November, excluded from consolidation. So what is the solution? For ultimate parent entities 2024 financial year, which is Jan to December, use entity B's 1 December 23 to 30th November. That's exactly what I said a little while ago. So we use the actual financial year results of the subsidiary and we add or aggregate the revenue together with the group revenue to test the threshold of the 750 million euros. Example, new group, one more example that is there, new group, AB group, years 1 and 2 revenue was equal to or greater than 750 million euros, but no prior years were there, so it will stay out of scope because if you remember, it requires at least 2 completed years for the third year to be tested. Year 3, 2 prior years greater than 750 million euros. Yes, absolutely. This third year can be in scope. Now, one example is that of a manufacturer, M&E Group A, ancillary interest income excluded, not an ordinary activity. So ancillary interest income is excluded, which is not an ordinary activity. But leasing company, interest and leasing income is included because it's a core business revenue. Now that what we just saw was Article 1.1.1 on application of the GloBE rules. Now we're coming to Article 1.1.2, which is for the adjustments for non-standard fiscal years. So let us look at the bare law provision of that. I can't call it law, but bare, let's say bare rules provision for that. If any fiscal year is considered under, by the way, these wordings are not exactly the rules wording. They have been simplified for ease of understanding of people. So if any fiscal year considered under Article 1.1.1 is not 12 months, then this 750 million euro threshold is adjusted proportionally based on duration. Very simple. If it is not exactly 12 months, you have to adjust it either upwards if it is more than 12 months or downwards if it is less than 12 months. So let us look at the commentary of that, consolidated commentary. So paragraph 14 addresses it. It addresses fiscal years. It's not equal to 12 months for M&E group. Then what do we do? Fiscal year is defined by the ultimate parent entity's accounting period. Simple. And it aligns with CBCR rules for consistency. So paragraph 15, proportional adjustment rule. So what do? We proportionally adjust the revenue. So core rule, if any of the 4 preceding fiscal years is not equal to 12 months, so what do? The 750 million revenue threshold must be recalculated proportionally. Calculation methods, there are 2 approaches. Adjust the threshold. For example, 9-month fiscal year. Then what we are going to do is simply 750 million euros multiplied by 9 months divided by 12 months. So 750 million divided by 12 into 9. Adjust the revenue. Example, 562.5 million revenue was over 9 months. Then we simply gross it up to 750 million euros. So formula is 562 million divided by 9 over 12. Same thing. Now, what was the purpose? It ensures fair application of the threshold. Obviously, I mean, because the whole idea was to consider annual consolidated turnover. But if it is not annual, then we should annualize it. So we should normalize it. So that's why we do these kind of an adjustment. Both methods achieve the same outcome. Local tax authorities may prescribe which approach to use. So uh, it's the local authority that can prescribe. Let us talk about a little bit about exclusion. This is Article 1.1.3. So what was 1.1.2? These were the adjustments for non-standard fiscal years. Now we are studying exclusions. So what is the provision, the core rule provision for Article 1.1.3 is excluded entities, which have been defined, are not subject to GloBE rules. Okay, let's go a little deeper into it. So paragraph 16 of the consolidated commentary, it talks about the core rule. Excluded entities are not constituent entities under GloBE rules. So what are constituent entities? This next article 1.2, which talks about M&E group and group, there is the article even after that, which is article 1.3, is actually about constituent entities. We're going to read there in detail what are constituent entities. Excluded entities are not constituent. In short, constituent entities are those on which GloBE rules apply, in simple words. Consequence, they are fully outside GloBE scope except for revenue threshold calculation. Now that's a very important point for us to remember. Now those entities which are excluded entities, they will stay out of the GloBE rules, but they will become relevant only when we are estimating the threshold, 750 million euro threshold. If you remember earlier on, we saw that we talked about certain excluded entities which were actually exempt from GloBE rules, but their revenue was considered while testing the revenue threshold of 750 million euros. So revenue threshold calculation, their income still counts towards 750 million group wide test. So now what about further specific categories of excluded entities are defined in Article 1.5 at the end of this chapter. Okay. Implications: avoid duplicative compliance burdens for certain certain entities, for example, non-profits or pension funds, etc. So it since these will be considered as excluded entities, so they will not undergo all these compliance hassles and burdens of calculation, etc. Maintains consistency by including their revenue for threshold test. How so? The only thing that is relevant for such entities, non-profit, etc., or pension fund, their revenue will be considered for testing, for testing whether the 750 million euros at a consolidated level was exceeded. Modifications under Article 6.1. When we read Article 6.1, we're going to see that there are certain exceptions to the general rule. Additional rules are there which may adjust the revenue threshold application in certain cases. So that was article that was all Article 1.1. We are going to in the next session we're going to study Article 1.2.